But with that, why don't we get started? Here's our agenda for today. Like I said, a more abbreviated version on my end, because I definitely want to, leave some time for what's likely to be a very spicy election season here in November. But we'll go over our asset class themes and rankings. We have updated these because there has been quite a bit of movement more recently in markets over the last three weeks. Some thoughts on stocks, bonds, and alternatives, and then we'll turn it over to Mike for the majority and the bulk of the presentation. Some big picture themes for the remainder of 24 and probably into 25. Some of these I'm sure will likely be with us for a little bit of time, because some of the thematical ideas are not meant to be changing very frequently. But I think there's a few things on here of note to touch on. Maybe we'll touch on the ones that have changed since last time. One is this upper left-hand corner. We did change this quadrant here because I think it's important to note despite all of the rhetoric and a pretty friction-full election season, there are two very positive things going on right now that are worth noting. One is that the economy is struggling quite nicely. I saw a note on the ride up to here in our New York office that Atlanta GDP now forecast for Q3 has ticked up from 2.6 to 3.2%. This is a pretty significant, or I guess, baseline around which to build an investment thesis around a sound economy. Because otherwise, if we were about to fall off a cliff, there'd be a lot of other things telling us that all was not right in the world. We also have the combination of that plus rate cuts, and you can use whatever charts you want to take a look at, but by and large, majority of the time when rates get cut on the Fed funds rate, that's stimulative for financial conditions, and financial conditions being stimulative is very positive for asset prices. So you can use whatever historical analogy you want. By and large, these rate cuts are very positive for financial assets, stocks, of course, but also in most cases bonds, because as rates come down, that makes current coupons more valuable. The other thing I just wanted to, along that line around rate cuts, this whole reading the tea leaves segment, just point this out because, we have had our first 50 basis point rate cut. I would say another 50 basis points, as the market was expecting a few weeks ago, is probably being called into question a little bit more because now we're having a very strong economic situation with jobs and fundamentals in the economy. So I think that's probably less likely to happen than it was maybe a few weeks ago. But I guess the point here is that once the Fed starts cutting rates, it's very unusual that they would stop and not continue on, at least in a more modest pace. So 25 basis points. So I think very similar to maybe coming into 2023, as we pointed out, the market is probably getting a little bit ahead of the Fed, and that does present a little bit of a risk to asset prices. But over the short term, but I think longer term, we still have, or for the intermediate term, we still have a pretty supportive setup. And then finally, just this global hotspots are spreading. Just that is worth noting because now we have an expansion of the Israeli conflict into Lebanon, southern Lebanon, and an enhancement of the ground war. In our estimation, necessarily isn't a net positive. As well, you've got ongoing conflict going on in Ukraine. So we have two global hotspots. Market did shrug off what happened in Japan a few weeks ago with the kind of blow up of the carry trade, and dealt with that pretty nicely. We seem to be dealing with what's going on in the Middle East and Eastern Europe right now just fine. But the longer these conflicts go on, I think the more systematic risk becomes layered into the asset price system, and that does present some risks that we want to be mindful of. Our updated asset class rankings here, you can see when the slide clicks over. We did make a few changes. You can see by and large, we're very neutral across the board stock-wise. Still have an underweight to Chinese or emerging markets, primarily Chinese equities. And it's worth noting, of course, they did bring out the Hank Paulson bazooka. I'm not sure who the Hank Paulson equivalent is in China, but they did bring out the kind of whatever it takes language in China, which is putting a very strong bid under Chinese shares. I think they're up 25% or so as of last Friday over the last 30 days. They are coming off a little bit because I think at the end of the day, it is a communist system and property rights are subject to interpretation. So we have to consider that as maybe more of a trade versus a long-term allocation, and that's not necessarily the realm or pools that we swim in short term. As far as bonds go, we did downgrade fixed income because I think there is some risk to the upside to rates from here over the intermediate term, particularly if we get strong numbers out of the economy and inflation by extension. So you can see here we just downgraded again, not again, but we downgraded our municipal and government exposure to neutral, so from a slightly overweight position coming into the quarter. We did take that opportunity to add to position, so we are at, I would say, our target duration exposure, which is a little bit less than the aggregate bond index, which feels very comfortable right now. And I think over this, more intermediate term, we're having some nice performance attached to that switch more recently. And then finally, alternatives, as everyone knows, we are a fan of what's going on the alternative side. And I'll touch more here on REITs in just a second as to what that could be telling us. But liquid alternative, private alternatives, these are the exact kind of conditions you would want to have for these strategies to work, because private and liquid alternatives work best when you've got friction in the system, meaning spreads widening, volatility in bonds, volatility in stocks, and those tend to be good conditions for active alpha strategies like alternatives can give us. I would say, one thing I've pointed out to our Atlanta Market Outlook clients is there's probably a new category I need to put in here, which is what I'm calling monetary hedges. Monetary hedges would be things like gold and Bitcoin. I know that does raise some eyebrows for some clients, but if we are concerned about the level of inflation and the Fed actually cutting rates into inflation, that's going to substantially potentially diminish the purchasing power of the dollar. And I think that's something that has happened. The dollar has come off the boil here a little bit, but we'll talk a little bit more about that in future Market Matters. This is just the chart I wanted to show relating to stocks. I think this was put together by Jefferies, showing what happens to these asset categories, mid cap, small cap, large cap, over the 3 months after the Fed's first cuts rate, 6 months after in green, and 12 months after in orange. And I think just for everyone's knowledge or understanding, we probably aren't going to be playing too much in the small cap side. I think, as everyone may be sick of hearing, I think there are some structural limitations to small caps, given the substantial influence of private equity over the last 10 years. I think they're kind of picking that index clean of good companies. And so our exposures are really much more located primarily in large cap, but increasingly looking at mid cap companies. And that has been a nice allocation for us, because you can see here they should have a little bit of outsized performance potential with rate cuts. And that's exactly what's happened since the Fed started cutting rates. So we're happy with that exposure so far. And increasingly, we will likely look here because the valuations are a little bit better in mid-cap. I'm calling this a Teflon markets because even though, we had the carry trade blow up here in Japan, which is what the spike was, where the VIX got all the way up to, believe it or not, 50 or 60, which is the GFC level and COVID levels of volatility. It's come right back down, has been increasing more recently as bond volatility has started to creep up. This is as of October 3rd, so I think it's kind of banged around here on the volatility side. This is the purple line, the VIX index. But what hasn't been banging around, and one reason why we think we're still in kind of a Goldilocks scenario for the economy, is this orange line, which is credit spreads. These are high yield bond spreads, haven't budged almost at all more recently. And this is kind of the dead giveaway that a recession is imminent, because what happens is, high yield companies start to see increasing levels of default, and then investors increasingly attach a higher premium to those bonds in the form of lower prices, and that's why this orange line starts to rise. Well, we haven't started to see that, which is why we think we're still in kind of a Goldilocks scenario for the economy at the moment. This is a current state of the yield curve as of quarter end. So I know the labeling can be a little tricky to see here, but let me just orient you real quick. On the left-hand side is the coupon rate or the interest rate of U.S. Treasury curve. This is all U.S. Treasuries. On the bottom here, we've got the duration of each of those Treasuries. So 30-year, 20-year, 10-year, all the way down to 3 months. And, what should be noted here is that, we started off, essentially at the end of Q2, and for the that part, end of last year with 3 months all the way up at 5.5%. Now we're down to 4.75. Market's clearly baking in rate cuts. This is exactly like the playbook that happens. Is as the Fed cuts rates, this shorter end comes down. So over time, what the market's telling you is that this 3 months should be down here somewhere between, call it 3.25 and 3.5, to have a upward sloping yield curve. And that's kind of the normal state of conditions that would reflect, no stresses in the fixed income markets. Or maybe clogs in the financial system is another way to think about that. But we've had, our first cuts. It has had an impact on the front end. And, I would say you expect this to come down more. If that doesn't happen, however, that's what we got to be watching out for, because then you've got some problems. And then finally, actually 2 more slides, then I'll turn it over to Mike. But this is a picture, a lot going on here. Just shows you what happens. This is from JP Morgan. What happens when the Fed starts cutting rates on the bond side. So now to the observation of the keen observer here, it is not 100% that bonds will rise in price or rise in value when the Fed starts cutting rates. The one exception, of course, being the 2007 timeframe, right ahead of the GFC. First 6 months after. The first 6 months is in gray. The next 6 months return is after, here in blue. And what you'll notice is, despite the fact that the Fed cut rates, investment grade market actually took a bit of a nosedive during the 2007 timeframe, as well as the high yield market, which is why we pay attention to these things, because it is, I think, gives us a sign of what's to come. But in almost every other period in recent history, when the Fed starts cutting rates, returns have been above zero, which would imply, greener pastures ahead for fixed income from here. And then finally, I do think this is worth noting. I am in New York today, and it's worth pointing out these are the 2 largest public landowners in New York. So SL Green, the largest Manhattan owner of real estate, office real estate, by the way, and Vornado Realty Trust. And then, of course, we've got that juxtaposed against the Vanguard real estate ETF, which is a kind of a much more diversified picture. And what you'll notice here is that after this starts, I think it's a 3-year chart. So starting in November of 21, these real estate investment trusts troughed down, if you can believe it or not, 65% at one point from November of 21. And now, amazingly, SL Green is now positive from where they started life in November of 21. So all that to say, and even Vornado is in the green now. So all that to say is, we've come a long way in real estate investment trusts. They do tend to lead private real estate, and I think this has been a bit of an albatross around the neck of markets, where people have been fearing a lot of downside to come as a result of commercial real estate and what's on the bank's balance sheets. I think the performance of these real estate investment trusts would suggest that the market has priced in already a lot of that downside, and that we could be looking at some greener pastures. Obviously, different categories of real estate will imply different return streams, but real estate's not a monolith. But office being the ground zero of all the issues I hear about from clients, this I think is a good picture, and they continue to rise, by the way, since the last time I showed this. Okay, so with that, just a couple of takeaways. I'm not going to bang on all of these here, but I think what was once a sleepy summer has now turned into a little bit more of an active period. We've got some not lift off of zero, but the first rate cuts have been put in place in September, and now I think the market is starting to price for the likelihood as opposed to the possibility of what lies ahead as far as the rate cutting environment. Still, I would just point out, all-time highs are a great time to be managing risk in a portfolio, dealing with those concentrated positions. As we pointed out previously, for our single stock strategy, we have been trimming back pretty meaningfully a lot of our tech exposure and looking at more, I would say, more traditional value exposure, things like financials or energy or healthcare. Those are all areas we've been adding to more recently. And, certainly our bonds, I think, present probably the biggest question mark for the portfolio, which is why we're staying, I would say that as a natural rate, underweight in duration with a little more of a credit exposure, because credit seems to be, performing just fine. And we'll certainly look to reevaluate that as we get closer to the eventual recession. Okay, with that, just want to point out some disclosures here as we have to. There's lots of data we've collected for this information, and Mike Townsend is not an employee of Colony. He's very much a part of Charles Schwab, and we're happy to be able to get him on because Mike is the Managing Director of Legislative and Regulatory Affairs. And he does, I think, a great job of explaining what's kind of in front of us, because we do have, as you all know, a very contentious and testy election season likely ahead. So Mike's going to provide some insights. And Mike, just feel free to tell me to advance it whenever you are ready.
All right. Sounds good, Todd. Thanks so much. And thanks for having me back on. Really appreciate it. Always enjoy chatting with you and your clients. As Todd said, I'm Mike Townsend. At Charles Schwab, we have a little office in downtown Washington, D.C., and that's where we watch what's going on. Halls of Congress, White House, regulatory agencies, SEC, and the Fed, and all the political developments, and try to figure out what it means for ordinary investors. And I spend a lot of my time doing this. This is like my Super Bowl season, so traveling all over the country and talking about sort of the intersection between Washington elections and markets. So that's what I'm going to do today. And I started with this side, which actually hit a lot of things that Todd talked about at the outset, which is, as I travel around, you look at the S&P 500, right, around 20% year to date, and yet there's this kind of undercurrent of anxiety among investors because of all these different things going on geopolitically. Got this election coming up in a month, but also, countries all over the world have had elections. You have a dysfunctional Congress that can't get much done. So all these different pieces, I think, sort of feed into each other and create a little bit of anxiety here as we head into the end of the year, even though the market is performing well. If you can go to the next slide, I'll just start right in Washington with a reminder that, the landscape is very, very divided in DC. 51-49 majority for the Democrats in the Senate, 220 to 211 for the Republicans in the House of Representatives. And, it's been really a struggle on Capitol Hill to get much of anything done. In the House, Republicans have a hard time staying all unified on issues. And even when they are unified and can pass something, it goes to the Democrat-controlled Senate and sort of falls apart there. So Congress has had a tough time this year. And if you go to the next slide, I'd argue that the most basic thing Congress is supposed to do every year is fund the government. It's supposed to do that by the end of September because the new fiscal year for the government started on October 1st. And they do that by passing the 12 appropriations bills that fund every government agency and every federal program. To date, they have passed exactly 0 of those 12 bills. So what happened is very common. Congress kicked the can down the road, and they passed a bill that just keeps the government sort of open and operating at regular levels through December 20th. And what that means, though, is that Congress is going to have to come back after the election. And remember, that's the old Congress, not the newly elected Congress that takes office in January. So you're talking about, members who have lost their race and to get reelected, or they're retiring. So there's always weird dynamics in that November, December period. And, who knows exactly how the election will play out. So Congress is facing a pretty tricky situation when they come back to potentially have a government shutdown right before the holidays. I don't think that's likely to happen. I think, the one option is that they just kick it into the new year and let the new Congress deal with it. But it's definitely something to watch. But Congress is out of session now. And if you go to the next slide, I'll hit on probably the biggest issue that's looming out there that is already coming to a head in Washington and in the context of the campaign, and that is taxes. We are going to have the mother of all tax code fights in 2025 because, as most of you probably know, all of the 2017 tax cuts, that's the Tax Cuts and Jobs Act that was passed in the first year of the Trump administration, all of those tax cuts expire at the end of 2025. Lower individual income tax rates, higher standard deduction. One for planning purposes is a big one. The exemption amount, the amount of assets that can be inherited without triggering the estate tax, would be cut in about half if beginning in 2026 if Congress doesn't extend something by the end of 2025. So you have all these expiring provisions, and there are dozens and dozens more that aren't on this list. That's kind of the catalyst for this big debate coming. But what you're seeing in the campaign, and this is not unusual, of course, in presidential campaigns, is the candidates throwing out all sorts of other tax ideas that could potentially be in the mix next year. So from the Trump side, you're hearing, we're going to extend all those expiring tax cuts, but we're also going to end the taxation on tip income and no taxes on Social Security benefits. And just recently, he talked about ending taxes on overtime pay. Harris, for her part, has said, let's let some of those tax cuts expire, the ones that apply to the wealthiest filers, and let those go back to where they were, while also expanding the child tax credit, creating a new tax credit for first-time home buyers. She's proposed a tax credit, increased tax credit for small business owners for their startup costs, and all these different things are sort of, typical of a campaign, right? You're sort of throwing out ideas to different constituencies. But I wanted to mention two that investors are particularly focused on. Number one, capital gains rates. Interestingly, Harris just a couple of weeks ago outlined her cap gains plan, and it differs pretty significantly from Joe Biden's. And I think that's notable that break has occurred. Biden, for a long time, through most of his presidency, has been pushing this idea that capital gains above $1 million in income should be taxed as ordinary income. And he would put that top rate at 39.6, back to where it was. And he would increase the net investment income tax. That is the 3.8% surtax on investment income for wealthier filers. He would bump that to 5%. So that would make a top cap gains rate of 39.6 plus 5, 44.6%. Well, Harris came out last month and said she favored a top rate of 28% plus a 5% net investment income tax for a 33% top rate, which is a pretty significant difference from Biden. So I just wanted to note that. The other one that I get all the time, could unrealized gains be taxed? This comes from a proposal known as the billionaires tax that Biden has long had and Harris has also endorsed. And that is essentially a minimum tax on assets above $100 million. And it would include, under the Biden proposal, a taxing of unrealized gains. Now, I have to say, among the things I'm worried about, this is not very high in my list. First of all, I don't think all Democrats in Washington are for this. There are no Republicans for it. And I don't know that you could get enough Democrat votes for it. There's also a ton of operational questions. How you try to think, what would the IRS form look like in which you had to try to, estimate the value of your art collection or some other difficult asset to value on an annual basis. And there's also no question there would be a legal challenge, and there are, I think, legitimate questions about whether it's even constitutional. So lots of talk about unrealized gains, lots of anxiety among investors, and I think that's probably higher than it needs to be, basically. I think it's pretty unlikely to happen. All of these tax questions, though, are going to be decided in the context of what is the election outcome and what is the configuration next year in Washington. Who has the House? Who has the Senate? Who's in the White House? Because if you have a Republican sweep, Trump wins the White House and Republicans control the Senate and the House next year, you're having a very different tax discussion than you are if there's a split Congress and Congress has to negotiate a deal. So it's really hard to kind of forecast how this will play out until we know what the election outcome is and what the configuration is next year in Washington. So I'll definitely be watching that. And you can come back to me after the election and ask me for more thoughts on sort of what direction I think it's going to go. It's going to be a complicated debate. If we go to the next slide, Todd, I think you mostly hit the Fed. I think I agree with most everything you said. I do think that the Fed is telegraphing a pretty slow process of rate cuts. They are currently projecting two more, the 25 basis point cuts. There are only two more meetings in November and December. And as you said, I think the odds are starting to actually come down on that. Still pretty strong indication that we'll be at 2 this year. and then maybe 4 next year or something like that. So definitely not in every other, not in every meeting type of scenario. Todd, as you know, anyone who says they have a crystal ball on exactly what the Fed is going to do is probably not telling you the truth. So they're very data dependent. We'll see how it goes. So let's jump in to the next slide. And I've used this for a long time to just sort of outline the flow of a campaign. Big red X's when people drop out. Wasn't as interesting this year because most everybody had dropped out long before things really got going. It's a good reminder that some of these people even ran for president in this cycle. But the big red X that I didn't expect, of course, is the Joe Biden one. And if you go to the next slide, I think I've got a great sort of visual on sort of what has happened here. And this visual looks at the enthusiasm of the parties for their candidate. And what I want you to notice is that in that July period, so post bad debate by Joe Biden, before he dropped out, only a third of Democrats were enthusiastic about having Joe Biden as their nominee. As soon as Harris comes in, she puts that back up into the 80s. And the one on the right is what you would expect, right? Democrats are for their nominee. Republicans are for their nominee. They're enthusiastic about it. Harris has essentially reset the race to where it ought to have been in a normal situation. And you're sort of fighting over that group kind of in the middle that maybe is more mixed. So I think that's a great visual. And if you go to the next slide, we are where we are right now, which is incredibly tied. This is a look at the polling averages put through 538. Used to be 538.com. Now it's a subsidiary of ABC News. I think they do a really good job at aggregating polls and sort of smoothing out some of the outliers and weighting by methodology. So you get a good snapshot, I think, through their aggregation of where the race is. And you look at this on the right and you think, it's incredible how close these states are. And these are the 7 states that are going to decide this election. All of them are under 2% on average margin. All of them are within the margin of error of all these polls. This could not be more tied. And to see an aggregation of polls come up with margins like 0.5%, 0.7%, it's just incredible. And even in the close elections we've had in recent elections, we have not had anything like this going in, where you had all the battleground states so close. And I think we're going to stay there right through the end. So if you go to the next slide, just some of the key dates. Important to remember that, in some states, people have been voting for a couple of weeks. One of them is my home state of Virginia. We started on September 20th, along with Minnesota and South Dakota. So, there are a lot of votes, real votes that have already happened in this race. And more states are coming online in terms of their early voting. We had the vice presidential debate last week. Historically, vice presidential debates don't really move anything in a presidential race. Frankly, vice presidential candidates don't really have a big effect on the race. I think there was some interest in the 2 vice presidential candidates, but the bar is really low. The basic thing each candidate needed to do was not make such a horrific mistake that it became like a big story for the presidential candidates. Both managed to clear that bar, and I think that was kind of a in the scheme of the race, kind of a non-event. We do have the Univision town halls. One change to this because of the hurricane approaching Florida, the Trump Univision town hall, which is for Hispanic voters, has been moved to next week on October 16th because that was supposed to be in Miami, and they're stopping things like that, obviously, in Florida. So they'll do that next week. And then we have a push to November 5th. Could there be another presidential debate? I don't think it's a 0 chance, but it's getting lower every day and getting closer and closer to 0. So we'll see if there's another event. Third-party candidates still matter, even though Robert F. Kennedy Jr., who earlier this year was polling nationally at 8, 9, 10%, even though he's out of the race, he's now endorsed Trump. There's still a Green candidate. There's still a Libertarian candidate. There are a bunch of small party candidates. There are a couple of independent candidates. And in a race this tight, they could really matter. And I'll give you a great example of what I'm talking about. 2016, in the state of Michigan, Hillary Clinton versus Donald Trump. Trump won Michigan in 2016 by fewer than 11,000 votes. there were 275,000 votes cast in Michigan for people not named Clinton or Trump. So you can imagine how, if some of those votes had gone one way or the other, the whole situation could have changed. So even though there's not a big name candidate, it's important to keep those numbers in mind. And we're now down to 28 days to go. Normally we'd be talking about undecided voters. And traditionally that has meant, you sort of picture ABC News going to Wisconsin and talking to 9 voters at a diner around a table, right? That's kind of your traditional undecided voter. I don't know that we really have those. I think the campaigns are really focused on unenthusiastic voters, voters who don't vote in every election, voters who, if it's raining, they just don't go. But voters mostly who are just sick and tired of the whole thing, and they're not super enthusiastic about either candidate. It's trying to get those voters to go to the polls that will be the real focus of the campaign. So in the next one, a really important reminder that even amidst all the attention to the presidential race, I think markets actually care more about who controls Congress, because at the end of the day, it's Congress that has to make laws. I mean, presidential candidates say all sorts of stuff about what they're gonna do, but it's Congress that can put 90% of that into actual practical reality. And that's why I think the markets care less about the sort of promises and rhetoric of the campaign trail, and more about the end product of what any of this turns into. So in the battle for the Senate, you see here a map of which Senate seats are up. 51-49 for Democrats right now, but 23 Democrat seats are up for re-election and just 11 Republican seats. Republicans only need to flip 2. They have essentially already flipped 1 in West Virginia. That's where Democrat turned independent Joe Manchin is the senator. He is not running for re-election. The Republican governor of West Virginia, Jim Justice, is the Senate nominee. He is going to cakewalk into that seat. So that right there makes it 50-50. And then, when you're looking at some of the other challenges for Democrats, I look at Montana in particular. Montana and Ohio are the last 2 red states that have a Democrat senator. And the Democratic senator in Montana, John Tester, is trailing in the polls. It's a really tough state for a Democrat. You also have tough races for Democrats in Ohio, in Michigan, in Wisconsin, in Nevada. I just think there's enough opportunities for Republicans to flip a couple of these seats. They're going to have a narrow majority if that happens. It'll be 51 or 52 Republicans probably, but they should capture the majority. However, I think there's a decent chance, that the House flips to the Democrats. And really, when you're looking at House races, 435 congressional seats, there are maybe 35 or 40 that are close. And when I look at those close races, I'm looking for congressional districts where there's a Republican member of Congress in a district that voted for Joe Biden in 2020, or a Democratic member of Congress in a district that voted for Donald Trump in 2020. Those are sort of universe of very flippable, kind of close toss-up races. And there are just more Republicans in that position than there are Democrats. So I think Democrats probably capture the handful of seats they need. Don't think it's a slam dunk. If that happens, would be the first time in history the House and Senate have never flipped in opposite directions in the same election. On the next one, I just wanted to wrap up with a few charts that kind of shed some light on voters and markets. This one's just kind of fun. The yellow circles are the years in which at least one of the House, Senate, or White House changed from one party to the other. And what I want you to notice is that from 1960 to 2000, we had 20 elections, but only 7 times did any one of the House, Senate, or White House change parties. But in the 12 elections since 2000, it's happened 10 out of 12 times, including 5 in a row. And as I just said, I actually think it's very likely that we'll make that 6 in a row this time. I think voters just want change. They're frustrated with not getting much done, and they keep changing the options in Washington. The next one gives a good snapshot of one of the most common questions. What is the best configuration in Washington for the markets? We use the Dow Jones Industrial Average, goes back 120 years plus. The best configuration for the markets is the one we have right now, except it's the rarest. And this is a really important thing to remember when you're talking about sort of election and market information. Small sample sizes are a really big problem. So it's absolutely factually true that the market has performed best in this scenario that we have right now. But this is only the 8th year of the last 120 plus that we've had this particular configuration. So I don't know that there's really a lot that you can hold on to there. If you go to the next one, this looks at how the market does in each of the 4 years of the presidential term. And I want you to look at that red circle down there at the bottom. In election years, the S&P 500 has been pretty decent, 7.5 or so average return. But if you go to the next slide, you get a breakdown of all those years. And what you're looking at here is 4 yellow circles that since 1928, the market, if you look at total returns for the S&P 500, the market has only been down 4 times, 1932, 1940, 2000, 2008. What was going on in those years? 1932, Great Depression. 1940, Europe is falling apart. World War II is around the corner. 2000, tech bubble burst. 2008, great financial crisis. Really important illustration that the market, the years that it has gone down in a presidential election year, it went down for reasons having absolutely nothing to do with the fact that it was a presidential election year. These are big macroeconomic, geopolitical situations that affect the market. And the market doesn't care about the election horse race. It just doesn't. There's no evidence historically that it does. If you go to the next slide, we looked at a couple of other things. How does the market react to election day itself? We used the S&P 500. What was it? 1 day, 1 week, 1 month after the election. Last 6 presidential elections, the market has been up 1 day, 1 week, 1 month after the election 3 times. It's been down 1 day, 1 week, 1 month after the election 3 times. Again, no pattern. No pattern at all to sectors, how sectors perform in election years and around elections. There's one that has been thrown around for a long, long time. Has there been a recession in the previous couple of years before an election? The incumbent has lost all 6 times that that's happened. Doesn't look like we have that situation here. And then one that I do sort of keep my eye on, market performance in the last 3 months, August, September, October, before an election, has been a pretty good predictor of the outcome. Generally, if it's up, that's good for the incumbent in the White House and his party. If it's down, that's not so good for the incumbent in the White House and his party. But there's a lot of data that you get tossed around here that just doesn't really hold up in terms of how elections and markets work together. So if you go to the next slide, I will finish up with 2 sort of visuals that will help bring that home. This is the growth of a dollar since the early 1960s across all different administrations. And, you see the little ups and downs that happen in the market. And we've had years where the market was down due to big events and that sort of thing. But obviously a very good trend line there. And on the next slide, this is a great illustration, I think, of what I'm talking about. If you had $10,000 in 1961 and you only invested when a Republican was in the White House, you'd have about $100,000 today. If you only invested when a Democrat was in the White House, you'd have about $500,000 today. Of course, if you left it in the market the whole time, regardless of who was in the White House, you'd have $5.1 million today. So my big takeaway, I think, for everybody is, remember that this is going to be emotional. It's an emotional time for everybody around the election. It's probably going to get worse. I can guarantee on November 6th or whenever it is that we actually know what happened, it's going to be pretty emotional for people. And of course, those emotions are terrible mix with your investing decisions. So I encourage people not to listen in particular to the financial news on the radio and on the TV, where you see these guys who go on and say, if Trump wins, it's going to be good for this and this and this. And if Harris wins, it's going to be good for this and this other thing. And I have the Trump basket right here, and I have the Harris basket right here. There's just no real evidence that any of that sort of plays out. The market just doesn't kind of get into that sort of speculation around some policy that could be implemented a year or 2 down the road. So try to take all that with a grain of salt. And if you do have questions and feelings about the election, and you want to think about your portfolio, I urge you to call Todd and his team and have that conversation before you make those kinds of decisions, because historically there's just not a lot to hold on to there. So I'll wrap up there, Todd, and maybe we have time for a few questions.
Yeah. We definitely have a couple, and thanks for that, Mike. On your last comments, talking about what was it? This right here. I was reminded, one of those sectors that was really polarizing was the green energy sector. And, one of my friends pointed out, another CIO, that under the Trump administration, actually, there's an ETF out there. I think it's called TAN. It's a solar ETF. It actually went up during that, in a environment where, certainly there was more favoritism to the gas and oil and gas sector. However, in the Biden administration, it's actually gone straight down, and when there's a lot of favoritism to that segment. So it can often be a very different outcome than what you believe.
Well, I think that's a great example of the sort of counterintuitiveness of some of this, right? I mean, it's just absolutely true. Energy is such a great example of, how you sort of perceive it's going to be for, depending on, what letter is next to the president's name. And so many other factors, of course, come into play.
100%. Well, let's get into a question or two. You did touch about a little bit on some of the cap gains tax, and just reiterating, I think, your thoughts there, and unrealized, of course, being most abrasive, I guess, if you will. So, I guess for clarifying your thoughts, you see it as unlikely, and then also, I don't know, more recently, there's been a lot of talk about Trump trying to implement a national sales tax. So, any ideas on both of those two topics to close that piece out?
Yeah, I think, like I said, cap gains actually has not been a big focus of sort of anybody in terms of the tax debate next year. Now, I do think that some of the proposals like Harris is talking about to raise the cap gains rate on the wealthiest sort of fits in right with this Democratic talk around we want to make sure that the wealthiest filers pay a little more, et cetera. But I haven't, and look, all this is going to come down to a big math problem, right? They need to raise revenue in order to make cuts elsewhere and that sort of thing. But the cap gains has not been one that has a huge cry around it right now in Washington. So we'll see what happens. Like I said, I think unrealized gains is a lot more talk than reality. I don't think that's a particularly strong one. And, something like the national sales tax, I mean, there are always and have been for decades, these ideas like, oh, we should totally change the system. I just feel that is pretty unlikely given, sort of the complexity. Our system is so embedded in everything that the idea, you remember in the 90s, it was a flat tax or a fair tax or, that sort of thing. And those kind of have their moment and then kind of never come to anything. That's not to say that there's no chance something like that happens, but I don't see it as a priority right now.
Right. 100%. The other one that clients were asking about, there's some clients that have exposure to opportunity zone strategies of types. And just as a refresher for the group, those are strategies meant to redevelop blighted areas. They were given, to state governors to decide where those areas were, but maybe some good evidence that those had the intended impact in most areas, not all, of course, but there are some tax provisions around that are set to sunset here. Any thoughts on opportunity zone, details there?
Yeah, I think there's certainly a possibility that they'll be in the mix, because of the way they were set up, some of the deadlines have kind of already happened, right? You had to be in by a certain date in order to take full advantage. The other thing I'm watching, I just said, I don't think cap gains is a huge priority, but, cap gains could change, the rate could change, and that could change the outlook sort of, so that talk about changing the rules in the middle of the game for some of, people who are already in opportunity zones. So I would watch that, but I do think that this is something that, has some bipartisan support, because it does affect communities in every state. Everybody in Congress has opportunity zones in their state. So there is some bipartisan support for, maybe enhancing or continuing that. We'll see. There's a lot of things in the mix next year, so we'll see sort of where this falls on the priority list. But I think there is some chance that there's going to be some enhancements to it.
Gotcha. Yep. So we'll soon be following that closely for all our clients that have exposure to those strategies. Last one, and then I think we'll probably wrap here. We're getting about to a quarter till on the hour, which unfortunately is, do you see any lasting or significant impact on the markets for these continuing hurricanes? So obviously, what's tragic, what's happening with Florida in particular, they're getting nailed, pretty close in a row with 2 Category 4, maybe 5 hurricanes. I mean, I think natural disasters are one of those things that really tend to not have a very lasting impact unless it's super, far-reaching. This does appear to be more regionally focused, unfortunately, for those that live in Florida or the Southeast. But, we don't see much by way of an impact on that front. But certainly, I think it will have impacts in other areas, things like homeowners insurance. That's a big question mark that I think really needs to be thought through. Coastal real estate, as people might be aware, we've had a little bit of a skeptical eye for coastal real estate in low regions for a little bit of time, just because there is that risk of flooding and hurricane activity. But I think that hopefully answers that question. But S&P 500 companies' workforces headquarters are distributed all across the U.S. and connectivity is really good in most organizations. So we don't see much by way of a lasting impact. But thank you for that
Todd,
question.
I'll just jump in and if I can add, from the sort of federal standpoint, I think you're hearing a lot of talk, obviously, about the cost in terms of FEMA dollars and all that sort of thing. And there's even some talk in Washington that Biden had floated the idea of calling Congress back into session to appropriate more money for disasters. It looks like that's not going to happen, but it is going to be a priority right after the election and when they come back to Washington. Because that big pot of money that is out there is dwindling fast because of these back-to-back hurricanes. So I think that it's also part of the sort of growing federal cost of these disasters. I think again makes it hard to have these debates around deficits and that sort of thing, because look, no one is against having as much money and as possible for to help people in these disasters, but it is a big number, and that makes it all the more difficult to get to some of these budget solutions that people would like to get to. So I just would throw that in as well.
Yeah, and last point, then we'll probably call it here, which is, I think it is emblematic of maybe an environment we're entering where you've got, higher financial asset volatility, right? Because of the outlook for inflation as being so uncertain. You combine that with a higher level of weather volatility, which I think certainly is an outcome or byproduct of, climate change. So you've got, probably a bit more of an active environment for asset prices setting up for the next 5 to 10 years versus maybe the previous 5 to 10. So, in that environment, we're constantly thinking about ways that we can kind of address that concern. Again, I go back to things that are stable value. Things like gold might have an opportunity in some portfolios, or Bitcoin at stable values that can weather those storms regardless of what's going on in environments. But to be determined on that. We still have some work to do there. Okay, well, I think we're going to call it here. We've gone a little bit over, but appreciate everyone hanging in there. And Mike, thank you so much for jumping back on and being our guest speaker. I think people got a lot out of this, and I think it's going to land well for those that are rewatching the replay here. So I want to thank everyone for taking the time today, and we'll see you all again the next Market Matters, which will be early November. Take care, everybody.
Thanks, everybody.